Good morning, Melon Heads. I hope you are well. Today is Wednesday, March 1st, 2023. We are officially two-thirds of the way through the gigantic bag of frozen suck that is Janu-February. Spring is coming, folks. Hang in there for just one more month. Warm weather on the horizon. But the big story today is the China reopening, and everybody is just amazed at this magnificent data from the Chinese PMI, or Purchasing Managers Index, a measure of the manufacturing strength in China. If you've been under a rock for the last few months, China had these unbelievably draconian lockdown measures in place. The whole country was basically under house arrest. Well, they rolled that back at the end of December. They very suddenly, they pivoted, if you will, and they just decided all the COVID measures were gone. We're going to reopen again. And well, today the PMI came out and they saw a huge surge in Chinese manufacturing. They went from 50.1 in their PMI to 52.6. Again, with PMIs, anything above 50 is expansion. So that is the most rapid expansion in Chinese manufacturing in over a decade. Now, there's a few things to keep in mind with that. Number one, they're starting from a very low point. So a rapid expansion from a very low point, that's, don't read too much into that data. When you're starting from nothing, it's real easy to move up. The other point I want to make is, the only thing worse than government data is Chinese government data. And we're going to look at something in a minute that just shows, well, maybe this doesn't really jive with what the numbers are saying. Also, we got some bad data again for the housing market. Mortgage applications are at a 28-year low in the United States right now, even as home prices have begun to decline. So 28-year low, you'll notice that is even lower than during the GFC. You got to go all the way back to the mid-90s to find mortgage applications as low as they are right now. And there aren't really comparable data points because the population has increased significantly since the mid-90s. But with that, let's shrink my big melon of a head and let's see what's going on in stocks this morning. We have got the S&P is down 9.5 points, or 0.25% at 39.59 right now. By the way, the S&P, looking at a longer-term chart of the S&P 500. Let's zoom in here. Yesterday, we lost that 50-day moving average in the S&P 500, so the algos maybe won't like that one. We'll see what happens today. Again, the NASDAQ, or the S&P, a lot of people have been talking about that 39.50 level. We'll see what happens there. The Dow Jones is currently down 31 points, or 0.1% at 32,625. And the NASDAQ is pretty much flat right now, down 11 points, or 0.1% at 11,444. Looking over at the DXY, the U.S. dollar is at 104.34, down about 53 basis points at the moment. It's been in decline ever since we got those hotter than expected inflation prints from France and Spain yesterday. That is the market repricing the likelihood of a higher rate hike from the European Central Bank. If the ECB is suddenly hiking more aggressively than the Fed, well, then you may see investors flooding into European assets versus U.S. assets. So I believe that's what's going on in dollar markets. Looking over at commodities right now, we got a mixed bag today. We've got gold is up about $10, or 0.5% at 1846. Silver back over 21. Basically flat for the day right now, but 2107. Looking over the PGM metals, platinum and palladium are basically flat. We got platinum is up about $10 this morning, or 1%. Crude oil at 76.64, down about 40 cents. Remember that China reopening, put a pin in that one. And natural gas is down about a nickel at $2.70, or 1.82% lower this morning. Looking at natty gas, still trading above that 9-day moving average, so I still have my open position in UNG on that one. Going to be sticking with that trade for a little while. Let's looking over at the bond market at the moment. We have got yields are up across the board this morning. The 10-year is at 3.96, up 4 basis points this morning, or 1.2%. It looks like the big winner in the bond market today, though, is the 3-year, or the big loser, depending how you look at it. These yields moving higher. That is the prices moving lower. The 3-year is up 6.5 basis points at 4.56. And the high point on the yield curve remains the 6-month Treasury, yielding 5.14% this morning. Also, taking a look at the 10-year Treasury yield right now, folks. The last 3 or 4 days in a row, we've stalled out right around 3.985 on the 10-year Treasury. Right now, we're at 3.96. So keep an eye on that level. And by the way, if you don't recognize this right now, what do we have here? This looks an awful lot like a bear flag forming on the 10-year Treasury. So assuming we break above that level, we're probably going to be breaking to the upside. All right, top story today. China factory activity stuns with the fastest growth in the decade. February official manufacturing PMI is the highest seen since April of 2012. Non-manufacturing PMI the highest since March of 2021. China's manufacturing activity expanded at the fastest pace in more than a decade in February. An official index showed on Wednesday smashing expectations as production zoomed after lifting of COVID-19 restrictions late last year. The Manufacturing Purchasing Managers Index shot up to 52.6 from 50.1 in January, according to China's National Bureau of Statistics, which I'm sure those dudes are totally honest over there, above the 50-point mark that separates expansion and contraction in activity. The PMI far exceeded an analyst forecast of 50.5 and was the highest reading since April of 2012. So why am I skeptical of this, besides the fact that I am automatically skeptical of any government data, and I'm especially skeptical of Chinese government data? Well, this is why. Oil. And I talked about this in my video I put out yesterday. You can make the numbers say anything you want, but you cannot fake the burning of millions of barrels of oil. And if China's manufacturing activity was really in this massive expansion period, then surely they would be consuming vast amounts of oil in order to provide the energy and to provide the plastic and the petrochemicals that goes into making the stuff, right? Well, according to the oil price, no, we haven't seen that. This is looking at WTI crude, and we're in the middle of what looks like a big bear flag right now in oil prices. So if this China reopening was really expanding at this incredible pace, we would see upticks in oil, and we're just not seeing it right now. And again, we do this here in the States. You know, we point to these jobs numbers and we say, oh, look, 100,000 people got part-time work at Starbucks as a barista last month. Look how strong the economy is. Well, all the manufacturing PMIs and all the oil statistics say otherwise. So that's why I'm a little skeptical of this China information this morning. All right, moving on from that one, let's take a look at this one. Mortgage demand from home buyers, this is back to the U.S., drops to a 28-year low. Mortgage demand fell for the third straight week as interest rates increased. We did see a little spike in mortgage demand back in January when we had those lower rates. Again, looking at the 10-year Treasury yield, if you zoom out here, we had these lower rates in January that gave the housing market a little bit of a shot in the arm, but that is now gone as rates are surging. Mortgage applications to buy a home dropped 6% last week from the previous week, and mortgage rates have moved half a percentage point higher in the past month. And it's not just mortgage rates on the rise that are a problem. Take a look at this. This is the S&P Case-Shiller U.S. National Home Price Index. That is a long name. But this is going all the way back to the year 2000. And the reason I pointed to it is look at this decline here. Starting in June of last year is when home prices in the U.S. on average started to decline. And the one thing that I'm noticing, although prices are still at obscenely elevated levels, all right, we're still way, way above the peak of the last housing bubble. I mean, almost double the peak of the last housing bubble. All right, so prices are still way up in the clouds. But the pace of the decline in the Case-Shiller Home Price Index is the fastest pace we've seen since really 2009, right? Only at the height of the GFC, late 2008, early 2009, did we see this chart coming down as rapidly as it's coming down right now. I mean, really, if you look at what this chart is looking at right now, it kind of looks like 2007, early 2008 timeframe. So keep an eye on that one, folks. And the reason why I keep pounding the table on all of these statistics, check this one out. This is from the Kobayashi letter today on Twitter. Interest rates by category. Credit card interest rates, 24.1%. Used car interest rates, 13.7%. New cars, 8.7%. Mortgages, 7.1%. Now look at the total debt in these categories. Credit cards, $986 billion. Auto loans, $1.6 trillion. Mortgages, $11.9 trillion. Record high amounts of debt and record interest rates on that debt. It's not sustainable, folks. This is not sustainable, not at the consumer level, not at the car buyer level, not at the homeowner level, and not at the corporate level. Check this one out. U.S. bankruptcy filings surge at the fastest pace since 2009. This is in Zero Hedge. Shout out to my man Tyler Durden. And for the last year, well, we're going to skip the political part at the beginning. 1 month ago, when looking at the recent pace of large bankruptcy filings, those with more than $50 million in liabilities, they noted a troubling trend at Zero Hedge. In the first month of the year, the number of U.S. bankruptcies had topped 20. That was 20 companies with more than $50 million in liabilities had gone bankrupt. And that was the highest in any other January dating back to 2010. Back then, 25 filings were seen as the economy was still reeling from the aftermath of the GFC. So, long story short here, we are seeing the fastest pace of large bankruptcies in the United States since 2010, which was the late innings of the GFC. Now, we're still nowhere near the peak of the GFC. The number of large bankruptcies at this point in the year was 63 back in 2009. So right now we are at, bear with me, I believe we're at 39 large bankruptcies year to date as of the writing of this article. At the height of the GFC, we were at 63. So GFC numbers, 'tis not, but things are still trending in that direction. We are in the early innings of this collapse, folks. I had somebody commented yesterday, when are we going to see a market crash? And, I just spouted off a couple of things. We've seen crypto collapses. We have seen the housing market frozen. We've seen stocks drop 20% last year. We've seen bonds are down more than they've really ever been as these yields have been rising. We're seeing, we had a GSIB bank, Credit Suisse, went under. I mean, we are in the midst of this market crash. It's happening slower than it's happened in the past, but it is happening. It's just the frog in the pot of boiling water, whatever that the term for that is. That's what we see going on. All right. Now, I just want to send a shout out to a couple of you magnanimous melonheads. Where are you in there? I'm looking for Mr. Nashville Pasta Man. Bear with me, guys. It takes a while to scroll. There. Oh, Freedom for All. Thank you, Freedom for All. He says, don't be fooled. The USG is your enemy. That is the U.S. government, as well as the enemy of the future of your children and grandchildren. I don't know that I would necessarily say the U.S. government is your enemy. I am generally not a big fan of government. I just think the natural human tendency to abuse power knows no bounds, and whereas power tends to be most focused at the government. So it's not necessarily any dig at any one particular government. I mistrust them all equally. It's human nature to abuse your power, and that's why I don't like concentrating power in any one location. Thank you very much, Freedom for All, for the super chat, sir, and the support of the channel. You are a gentleman and a scholar. And shout out to Nashville Pasta Man. I love that name. That is a great name. Mr. Melon Man, keep it up. Well, thank you, Nashville Pasta Man, for the super chat and the support of the channel. I shall endeavor to meet your expectations, sir. And thank you to my Patreon supporters. You guys are awesome. Today is Wednesday, so today at 7 p.m., I have it up on the board, is our weekly get-together on Zoom. Looking forward to talking to you guys on Zoom tonight. Link down below in the description should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Shout out to my Blue Wrenches and my moderator, Mish. Thank you guys for keeping things neat and tidy in the chat. And until next time, live small and dream big.